Ladies and gentlemen, good day and welcome to Capital Small Finance Bank Limited Q2FY25 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sarvajit Singh Samra, Managing Director and CEO. Thank you, and over to you, sir.
Thank you, Siddhant. Good morning, everyone, and thank you for joining Capital Small Finance Bank Limited's earnings call. We have already uploaded the results and the investor deck on the exchanges. I hope everybody had an opportunity to go through the same. Joining me in this call are my colleagues Munish Jain, Executive Director, Aseem Mahajan, CFO, Raghav Agarwal, Chief Risk Officer, Sahil Vijay, who is Head of Treasury and Investor Relations, Bharti Babuta, who is part of Investor Relations team of the bank, and SGA, our Investor Relations advisors. Let me begin with an overview on economy along with industry, post which Munish will provide a detailed overview of our business performance. India's economic growth remains on a strong footing amidst ongoing geopolitical risks globally. The GDP grew by 6.7% in between April to June 24, marking as the fastest growing major economy in the world. The Indian banking sector continues to remain resilient, supported by strong internal mechanism and status of domestic systematically important banks. Agriculture is expected to perform well, supported by above normal rainfall and robust reservoir levels, while manufacturing and services activities to remain steady. Private consumption will be supported by healthy Kharif sowing, coupled with sustained momentum in consumer spending in the festival season. The credit offtake of the banks moderated to 13% as of September 24, as compared to 16% in end of March 24. A large part of credit growth moderation has been due to slowdown in retail segment, including unsecured loan and mortgages. Large corporate credit growth has picked up a bit, while SME loans continue to deliver strong growth. Deposit growth also continues to remain range-bound between 11 to 13%. Recently, RBI in its monetary policy kept repo rate unchanged at 6.5%. However, the Monetary Policy Committee decided to change the monetary policy stance from withdrawal of accommodation to neutral and remain unambiguously focused on durable alignment of inflation with the target while supporting growth. We have successfully closed the September 24 quarter with a remarkable 33.3 crores profit after tax, reflecting a strong 37% growth on year-to-year basis, with return on assets of 1.4%. Our gross advances have grown to 6,718 crores, registering a growth of 15% year-on-year and 5% on quarter-on-quarter basis. Our asset quality improved with gross NPA reduced to 2.6% and NPA of 1.3% against 2.7% and 1.4% respectively during the corresponding quarter. We continue to maintain a healthy CASA ratio of 37% plus, aligned with our strategic focus. With continuous focus on innovation, customer-centric strategies, and operational excellence, we remain committed to deliver value for all stakeholders as we progress towards a vision of inclusive growth. Thank you, and now I'll hand it over to Munish, who will provide you a detailed overview of the business performance during the quarter. Thank you.
Thank you, Mr. Samra. Good morning and warm welcome to all of you. We are turning intent into actions as we tread on our growth journey. I am pleased to share the financial highlights for the quarter/half year ended September 30th, 2024. Advances during this quarter is broadly, the growth of the advances during this quarter is broadly in line with the bank's estimate. Our growth journey, re-energized with growth capital infusion, is showing an upright progress, with gross advances stood at 6,718 crores as on September 30th, 2024, represented by a growth of 15% year-on-year, 5% on quarter-on-quarter, and 9% for H1, that is year-to-date figure. We are a secured lender with 99.8% being secured book, and 82.3% of the book is collateralized by immovable property or bank FDRs. Further, we are having zero direct microfinance exposure. Fresh disbursement during H1FY25 is 1,345 crores, which is grown by 33% on year-on-year basis. This disbursement constitute 21% to MSME segment, 23% to mortgage, 20% to agri, 22% to the corporates and the NBFC segment, and remaining to the consumption loans. The disbursement during the quarter was 592 crores. Our advances constitute of agriculture being 35%. It was 35% in Q1 FY25 and 39% in Q2 FY24. Mortgage presently 27% against 27% a quarter back and 26% a year back. MSME 20% against 21% a quarter back and 20% a year back. Corporate/NBFC lending at 11%, which was 10% a quarter back and 8% a year back, with consumption lending at 7% all the three periods. Our experience being in the lending business for more than 2 decades helped us in putting in place the streamlined credit assessment processes and risk management practices that has allowed us to consistently maintain a superior asset quality. Our GNPA 2.61% for Q2 FY25 against 2.73% in Q2 FY24 and 2.69% a quarter back, and net NPA of 1.29% against 1.36% in Q2 FY24 and 1.35% a quarter back. Our MSAs continue to be on collection and resolution even for the sticky loans, with very near to zero write-off, that is 0.1 crores only, and nil NPA sell-off during the quarter. Over slippage ratio for the Q2 FY25 stood at 1.27%, with upgrade and recovery ratio is very nearer to that of 1.2%, which is calculated on annualized basis. Our credit cost remains range bound, and same is 0.19% during Q2 FY25, and the same remains range bound historically, including the COVID period. During the quarter, we have created some additional provision to boost our PCR from 50.6% a quarter back to 51.3% during the end of this quarter. Our SMA 1 and 2, calculated as a percentage to the advances, improved to 5% as on September 30th, against 6.4% a quarter back. Now moving to the liability side. The liability side continued to be positively skewed towards the deposits, which constituting presently 81.4% of the balance sheet, and out of this 93.7% being the retail deposit, and out of the liabilities another 4.1% being the borrowings, which is providing us a liability expansion levers. Our deposit book grew by 11% year-on-year to 7,780 crore as on September 30th, with a CAGR of 15% from FY19 to 24, while maintaining a healthy CASA ratio of 37% plus. Our CASA ratio, which was 37.8% a year back, is 37.1% at the end of the 30th September. We have consciously calibrated our deposit growth owing to our low CD ratio and high leverage ratio before the growth capital infusion. The cost of the funds for Q2 FY25 stood at 6%. The same was also 6% a quarter back, and our cost of deposit for the quarter being 5.9%. The average credit to deposit ratio for the bank has inched up from 79.1% in Q1 FY25 to 82.4% in Q2 FY25. We aim to take this ratio to mid to high 80s going ahead. Now I'm talking about the profitability. Our pre-provisional operating profit has increased to 48 crores against 35 crores in corresponding quarter, registering a growth of 40%, and profit after tax stood at 33 crores against 24 crores in the corresponding quarter, registering a growth of 37%. Our PAT growth is driven by increase in net interest income by 20%, increase in the net total income by 26%, and reduction or optimization in the cost to income ratio. Our non-interest income has increased to 26 crores against 17 crores in the corresponding quarter. Further, our cost to income ratio during Q2FY25 has declined to 61.4% against 64.8% in the corresponding quarter and 63.2% in Q1FY25. Our NIM has increased to 4.2% in Q2FY25 against 4% in the corresponding quarter, and our operating margins improved to 2.1% against against 1.7% in corresponding quarter and 1.8% during the last quarter. The operating margin is being calculated on average asset basis. Our ROTA has improved to 1.4% in Q2FY25, and return on average advances increased to 2.1% against 1.1% and 1.7% respectively in the corresponding quarter. Our return on equity during Q2FY25 is 10.8% against 9.9% in Q1FY25. The capital adequacy ratio is at 26.3% at the end of the Q2 with LCR ratio of 238%, giving us enough legroom to further improve our CD ratio. Our branch network at the end of the quarter is at 180 branches spread over 5 states and 2 union territories. During the quarter under review, bank has expanded its network by expanding to one more state/union territory, that is the union territory of Jammu and Kashmir. Going ahead, we remain committed towards achieving our loan book growth as guided earlier of 22% plus during FY25 by capitalizing on growing MSME, mortgage segment, coupled with expanding our middle income group segment. Our focus on operational efficiencies and expansion in NII and increasing fee income will be our key drivers for our annualized ROA target of 1.4% plus for FY25 and continued expansion going ahead of the ROA. With this, I'm requesting my moderator to start with the question and answers.
Thank you very much, sir. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Narendra from Robo Capital. Please go ahead.
Hi sir, am I audible?
Yeah, you are audible.
Yeah. Thanks for the opportunity and congratulations on a good set of numbers. First, would it be possible for us to give a further breakup of our loan book into agricultural loans, housing loans, LAP, if possible?
Sure, surely. Our agriculture loan presently constituting 35% of the portfolio, and it was 35% at the end of the last quarter. Mortgage is 27%, and the same was also 27% in Q1. Our MSME segment is 20%, which was 21% in Q1. Our corporate, including NBFC lending, is at 11%, which was 10% a quarter back. And our consumption lending is 7%, which was 7% a quarter back.
No, sir, I get that from the PPT, but would it be possible to give a product level kind of a split? As in a housing loan, what would be the percentage of housing loans, or what would be the percentage of LAP? Would that be possible?
So if we talk about the housing loan and the LAP, they are the subcomponent of the mortgage. Mortgage is 27%. Presently, housing loan and LAP are almost equally between this, or I can say between 13 to 14% being the housing loan, 13 to 14% being the LAP.
Okay. And your agri term loans, would that be the most of the component of your agricultural loans?
Our agri term loan will be around 7 to 8% of the portfolio, and around 27% will be the agriculture KCC loans.
Okay, understood.
So the 35% in the agriculture portfolio.
Okay, understood. Sir, what I wanted to understand is, even the largest of the banks aren't able to do the credit cost that you are doing, right? So what gives us the confidence that the credit cost will be maintained from between 1 to 2, 0.1 to 2%, right? Because historically also we have been around 0.3, 0.4%. So what gives us the confidence that we stay at the current levels going ahead?
If we look into our credit history, we being as a model, we are a lender to the middle income group. And we have purposefully selected this particular segment, and we have all demonstrated in a steady stable credit cost, which typically remain in the range of 0.1% to 0.3, and except one of the year when it crossed 0.3, that is FY22. This particular thing is attributed being our specifically identified niche, that is the middle income group, plus we are a secured lender with 99.8% being the secured book and 82% plus book. We have a collateral of more than the value of the loan in the shape of immovable property or the bank FTRs. So we are a true term collateral lender, and we are a granular lender, and our perspective is to be the primary banker of the customer. Rather than acting as a standalone term lender, we are there to ensure that the client, we have become his primary banker or the main lender of his book. So along with this, lots of such practices which we do, like sourcing from the branch channel, that is we follow the branch-led business acquisition model, so that we need to know our customer well before we underwrite him. So all these practices and lots of other practices which we are following, which are giving us the confidence, and historically, now we being a lender now for more than 24 years. And we have a 24-year track available, which has shown the various events, including a lots of black swan, be it COVID, be it Demon, be it GST implementation. And we have seen all those events, a lot of social macro environment changes, a lot of political changes. So during all these changes, so we are able to demonstrate our credit cost remain in the range of 0.1% to 0.3%. So which giving us a further confidence that given we are continuing with our model, which we know well, and given we know the customer segment, which we understand well, so we are keeping ourselves confident to retain our credit cost within this particular range as we move forward.
Okay, great, sir. Also, what would be your LTV on the book, and given that you have a target of around achieving a 20% kind of loan book, so currently we are at 15%, if I'm not wrong. So is the second half going to be much better than the current half? And do we still stand by the target of 20% loan growth?
If we talk about the growth rate, we currently we are targeting a growth rate of 22% plus for the fiscal FY25. Out of this, if we look into the H1 we have already grown by 9%. So if we talk about a year-on-year basis, just before the growth capital come in, there has been some muted growth in the FY24 pre the capital raise period. But if we talk about the current fiscal H1 growth is already 9%, and current fiscal, 4 of the fiscal, we're targeting a growth of 22% plus. So given that banking industry look out an historical trend line, so we are confident that we will be able to achieve the stated growth target as we set in the beginning of this year.
Okay. And sir, LTV?
So LTV perspective, LTV will be different LTVs depending on the product. Like agriculture, we typically look for a LTV of 50%. In the LAP, we are typically looking for a LTV of 50% to 65%. In housing loan, it will be 67% to 78%. In the MSME segment, it will be 75% to 82%.
Okay, understood, sir. Thank you and all the best.
Yeah, thank you. Thank you, Narendra.
Thank you. Our next question is from the line of Preetesh from DAM Capital. Please go ahead.
Hi, sir. Good morning. Just a couple of questions. One is the other income. Anything one-off in that, in the sense treasury, or is it all fees benefit?
Pritesh, if we slice the other income, this particular other income, this time we will find, if we compare it with the corresponding year of the last year, September, over other income which is 1.08% to the average advances, which was if I look into the last year, the same number was 0.8%. So we have been improving it from 0.8% to 1.1% for this particular period. So this is primarily consists of the core income, and there is the treasury profit will be very negligible. That will be hardly 0.05% types. So, but one important point I like to mention here, that this quarter, as against last September, 0.12% is the penal charges, which was earlier sitting in the interest income. so which has moved from the NIM to the non-interest income. So 0.12%, which otherwise had been comparing it to the Q2, would have been sitting in the interest income, which now, because of the regulatory guidance, now moved to the non-interest income, which is 0.12%. So that is the one change movement. Because the comparative basis will be there given the regulatory environment change. So apart from this, non-interest income, which is 1.1%, including 0.12 being the penal charges, are typically primarily over core income, which is consisting, if we talk about, this element includes 24.2 crores are the net interest income out of this, and the remaining 1.5 crore is from the AD2 business.
Okay. So the breakup you gave was of the 25 crores of other income which came this quarter, right?
Yes, the other income came during this quarter.
Got it. Second question was on your PCR. You mentioned in your opening remarks saying that you have enhanced the PCR this quarter, which is visible. What is your thoughts from here on? Basically, how have you made up some policy or made up your thoughts in terms of how you want to take the PCR going ahead?
Typically, Pritesh, if we talk about our internal guidance, we always looking to maintain a minimum PCR of 50% plus. Plus, for the assets which are beyond the NPA aging of more than 4 years, we like to create a PCR of 100%. Plus, any unsecured piece, which is NPA book, we like to create a PCR of, or if it is NPA remain more than 1 year old, we typically like to create a PCR of 100%. So these are the three basic underlying guidance on which we typically follow our PCR guidance. So I'm restating, that is the NPA book more than 4 year old, 100%, unsecured more than 12-month-old, 100%, and overall not less than 50%. These are the three guidance which we have internally, and basis this we keep on reworking on the PCR. PCR is typically to report that is what is the expected loss out of it. I just like to reiterate, if we look into our historical trends, we have never sold any NPA asset, and our write-off during this quarter is also very negligible, and including the whole of the year, it is very, very negligible. So we understand the slippage is also there, but the PCR we believe is maintaining at a sufficient number, so which is so that the right confidence is given to the investor side.
Got it. But sir, I got your philosophy or got the policy of doing a PCR, but anything over and above that, is there any thought process to that, or we'll be following this policy only for some time now?
So we intend to follow this policy as we move forward. Just if there is some macro environment changes, we will review this policy as per that.
Got it. Second, last question from my side is on the branches front. So we've seen 3 branches I think open this quarter, 180 from 177. So what is the progress on that? How much can we expect in Q3 and Q4? Anything on that? Because we had a target of about 200 plus this year. So what is the progress on that?
So typically, as we discussed in the last earning call also, we started the branch working. We are intending to keep it 200 plus branches by end of this fiscal. So branches typically lots of activities being involved starting from the real estate development. So in the Q3, we have opened 3 branches in Q2, and we are anticipating an opening of around 7 to 10 branches in Q3 and remaining in Q4 to take over tally to 200 plus. So we are still very confident towards achieving this towards 200 levels by end of this fiscal.
Got it, sir. Thank you and all the best.
Yeah, thank you, Pritesh.
Thank you. Our next question is from the line of Chinmay Nema from Prescient Capital. Please go ahead.
Hi, sir. Good morning. A couple of questions from my side. The collections were marginally down on a Q-on-Q basis, and the gross slippages were also up about 30 bits. Could you give some color on which segments are driving this?
So typically, if we look into our collection efficiency or the upgrade ratio over current quarter, our slippage ratio is typically 1.27%, or in a numeric basis, it was 21.8 crores, which was 16.3 crores a quarter back. But similarly, we have been able to improve our collection ratio also. Our upgrade and recovery ratio, which is presently 1.2% or in a value basis 18.3 crores, the same number was 14.6 crores a quarter back. So even if there has been some increase in the additions or there is the slippage ratio, there is a corresponding similar increase is also there in upgrade ratio. So we are able to maintain our, rather improve our gross NPAs. So both the things are moving in the similar direction, and that is since both the numbers are not very far away. And that is just percentage basis look like different, but on the value basis, I just shared the number are very nearer to each other. And even if you look into the collection efficiency for the current quarter, which is 97.1%, and the collection efficiency is quite in, which was in the Q2, which was 98.5%. But if I slice it further, if you look into the SMA numbers, over SMA 1 and 2, which was 6.42% at the end of June, has improved to 5% by end of the September. So we are able to improve our metrics or our risk assets down from the, which we call it a SMA number, from special monitor number from 6.42 to 5, and also maintaining and reducing the GNPA number. So these are the numbers. This is the statistically I like to say the numbers on both the sides.
But sir, qualitatively, are you seeing stress in any of your books, agri, MSME, corporate? And like just want to just an extension of that, our corporate share of corporate book has increased from 8% to 11% on a YOY basis. And if I compare the incremental loan book, out of the 852 crores that have grown on a YOY basis, 242 crores are from the corporate book. So, if you could give some color on how much of this is microfinance exposure, and in general, how does microfinance affect your business? What do you have any FLDG arrangements with these corporates? Some sense around how the stress building up in general in the sector is affecting your book.
Surely, if I talk about the quantitatively about the asset quality side, presently we are not seeing any stress building up in any of the portfolio. We believe all the portfolio we are having on the segment is in control, and we are not finding any stress as one point of the time as we talk presently. And if we talk about our NBFC segment, NBFC and corporate lending, which is 11% at the end of the current quarter, was 10% a quarter back. So there is a very marginal increase in the quarter. Just if we compare it with the last September, the number was 8%. And if I talk about our MSME lending to the MFI versus lending to this particular pie, let me just give you a minute. I just give you the split of it. Just a second. Just hold for a minute. We have a very limited MFI exposure. The MFI exposure presently cumulative is 59 crores out of the total NBFC book. So out of the total NBFC book, over MFI exposure was 59 crores, which was 73 crores in the June quarter. So our NBFC MFI exposure has reduced from 73.8 crores to 59.6 crores by end of this quarter. And all the MFI we are having are typically we are having majority of the case we have a FLDG arrangement to protect us.
And so what is the thought process behind this book? Do you plan on increasing it going ahead?
As I shared about the data side, MFI NBFC, we have shown a decline during this quarter from 73 crore, which was already was a very minuscule number. We have reduced from 73 crores to 59.6. We are keeping watchful of the macro factors and the situation around it, and depending upon the macro factor, we will take the call.
Got it, sir. And last question from my side. Could you talk about growth in your newer states? What kind of traction are you seeing? I think in the previous call you talked about the larger strategy of expanding to the newer states. So in terms of disbursement, loan book growth, branch expansion, what are you seeing in your newer states? Some subjective color around that.
So if I talk about the newer states has been showing a good traction. If I talk about on year-on-year growth, we grow by 15% on advances. If I talk about out of Punjab book, typically has grown by 21%. And if we talk about the component of the Punjab versus out of Punjab, The Punjab share, which is 81.42% at the end of the last quarter and 83.97% at the end of the last half year, is 80.93%. And or I can say our out of Punjab book has improved from 16.03% to 19.07% by end of this quarter. So out of Punjab book is growing faster presently, and they are start contributing to the big way in our growth number.
Got it, sir. I'll fall back in the queue. Thank you.
Thank you, Chinmay.
Thank you. Our next question is from the line of Mona Sri Soni from MK Ventures. Please go ahead.
Yeah, hi. I wanted to know your guidance on the cost to income ratio, given that we're planning to open more new branches in the second half of the year. And also, relating to that, do we maintain our 1.4% return on total assets guidance for this fiscal? Thanks.
Yeah. I just take the second component of the question first. Yes, for the Q2, we are able to deliver 1.4% ROA, and our annual guidance for the fiscal was 1.4% for the annualized basis plus. So we are quite confident of maintaining the same 1.4% plus, and other we are confident in the coming years to come. We will continue to expand our ROTAs as we move forward. So there are a lot of drivers, including the NIM driver. As I said, optically it look like the NIM is 4.2, but given our penal charge, which has moved from interest to the non-interest. So in that particular way, we are able to expand our margin in that side. If I come to the second point, which we talk about the cost income ratio. During the quarter under review, our cost income ratio was 61.4% against 64.8%. And now if you look into the, I'm sorry for this, our OPEX average asset, which is typically for the H1, is typically remain in the range of 3% to 3.15 or 3.2%. And we are giving the same guidance in the beginning of the year also, and now we are retaining the same guidance. That we believe our OPEX will continue to remain the same range bound in the current fiscal. And coming year onward, we will be start showing the next after the 1 year from away, we will start looking into the OPEX expense reduction. But we will be one side opening the new branches, which will be a pressure on the OPEX, and the second side over existing branches. The matured branches has contributing higher and bringing down the OPEX significantly, and our scale is bringing down the OPEX significantly. So both the things are presently neutralizing each other. So we are seeing the OPEX to be remain around the same level as we move forward for the current remaining part of the year.
All right, thank you.
Thank you, Monsri.
Thank you. Our next question is from the line of Anand Mundra from My Temple Capital. Please go ahead.
Hello. Good morning, sir. Thank you for the opportunity. So what was our OPEX ratio for this quarter?
61.4% cost to income ratio against 63.2 a quarter back and 64.8 in the corresponding year quarter.
Sir, in terms of OPEX by total AUM, that figure is...
So if I just have this number, it will be operating expansion. So it will be around 3.2% for the current quarter against 3.1% in the last quarter.
Okay, 3.2%. All right. And sir, in the previous call, you had alluded that as there is a...
Sorry to interrupt, Mr. Anand. Your voice is a bit feeble. Can you please repeat your question?
Am I audible now?
Yes, sir. Please go ahead.
Yeah. Sir, in the last call, you had alluded that as and when the CD ratio goes up, there is a improvement of NIM that can happen. So like if the CD ratio goes up by 100 basis, there's a improvement of about 5 basis in the NIMs. But sequentially, even though the CD ratio has gone up, we've not seen any improvement in NIM happening. What is the reason for this?
That the reason is that typically over interest component includes the penal charges. Earlier, the penal interest was the component of the NIM. Now that has moved to the non-interest, which is presently for the current quarter contributing 0.12%. 0.12% has moved out of the interest income to the non-interest income, which otherwise, as per our historical accounting, was typically sitting in the interest income. So yes, with the increase in the CD ratio, the margin has increased. But because of the changed accounting principle, the penal interest has taken a shape of the penal charges and start looking into the non-interest income. So you look over non-interest income as looking at 1.1, which includes 0.12% of the penal interest component. So that is the accounting change. So because of the current quarter, we increased our CD ratio by basically 3 basic points. So there has to be an increase of 12 to 15 basic points, which has increased but sits in the non-interest income because of this accounting change.
Got it. And sir, can we expect the non-interest income to steady?
Anand, I just missing your voice. Your voice is very feeble. Can you please repeat, please?
Just get to a better network again.
Maintenance or non-interest income of 1%.
Hello, Mr. Anand.
Yeah.
Hello?
Yeah, Anand.
Yeah. Is this better?
Yeah, slightly better, Anandji.
Sorry for the trouble. Sir, just wanted to check. So our non-interest income should remain sticky at this level, around 1.1%. Is that a fair assumption?
Yes, we are intending to maintain in the range of 1% to 1.1% as we move forward, which includes our penal charges now, which is 0.12.
Okay. Got it. And so my final question was on the AUM growth. So you alluded that last year, because of the IPO in the second half, our advances growth was slightly lower. And that's why probably this year we'll be able to do a 22 to 25% advances growth. But I just wanted to understand beyond this year for FY26, what would you expect our advances growth to be?
Anand, if we look into the current year we grew 9% in H1, and current year we have given a guidance of 22 to 24, or I can say 22% plus growth. So we believe we are quite confident of retaining that. And current year the growth is coming from the existing branches, that is the branches we set up before the IPO. The new branches we are building up will be getting positional operational in Q3, Q4 and slight few in Q2. So those new branches will start contributing in the next year, that is the Q&F next fiscal. So the current year growth is from the existing sweating, and the next year we will be getting the new capacity and the existing branches. So we are confident of maintaining or increasing our advance growth as we move forward. And yes, it is a macroeconomic environment. So given the bankers are the typically multiplier of the Indian GDP. So I believe if the present GDP growth continue to grow, so we have enough opportunity to continue to grow our advance book as we move forward. So current time I am not giving any number graphic for this, but we are quite confident of accelerating our advance growth as we move forward.
Got it, sir. So thank you. If I have any more questions, I'll fall back in the queue. Thank you.
Yeah. Thank you, Anand.
Thank you. Our next question is from the line of Sukriti from Laburnum Capital. Please go ahead.
Hi, sir. Good morning. First thing on the, we maintained the advances growth, but this quarter the disbursements came down quite a bit. I think 22% down from last quarter. What was the reason for that?
So there is no specific cause there. So typically, as a matter of strategy, we typically if you look into the H1 disbursement for the fiscal is typically 33% more than the last year H1. So typically, as a matter of strategy, we typically build more in Q1 from the corporate lending. So that's why the first question comes that we increased from 8% to 10% by Q1. So that is the way we have upfronted some of the large corporate disbursement in the Q1 instead of taking it to the Q2. So that may be a slight change in that particular structure. But otherwise, disbursement perspective, H1 versus H1, there is a 33% growth. And there is, on the ground level, things are shaping up and the growth is coming. Even if I look into my MSME book or my mortgage book, both the books against my 15% growth in the book, they are grown by 17% plus. So we are quite confident of continue to growth as we move forward.
Is there an element of cyclicality between Q1 and Q2 growth because of the agri book?
The cyclicality in the agri book is typically is more in the Q3 types. So no H1 or H2, yes, there is always H2 in historically, not just because of agriculture, but in the industry perspective and we also. H2 is always higher growth than H1 in the advanced numbers. That is the historical trend line available, that H2 you are able to grow better than H1. So that is what we believe will be the norms of as we move forward.
But 2Q you're saying is just because there was some corporate loans that were disbursed in Q1 instead, and is just the drop is possibly a one-time anomaly?
That is, I can say, not a one-time anomaly. Basically, typically, Q1 is typically we are trying to offset the agriculture-based, you can say, the impact, which is bringing down the assets by Q1 and Q3. So we are making a lots of work in that direction, so that there we will continue to show an upward trend in all the quarters. So maybe in Q1 and Q3, maybe not that high growth, but yes. So keeping in view that some structural or some sort of internal change are doing. So as part of that particular thing, some sort of the advantage which we are doing in the Q2 historically, we move it to the Q1. So that is just a change. And otherwise on a H1 basis, with 33% growth has been come in the disbursement number.
And so the second question on the ticket sizes of your corporate loans, I think they've grown 30% over last year. And even if I look over 2 years back, it's 60-65% up. Is there any space within your corporate book that you're getting excited about, which is driving this increase in ticket size?
So typically, if you look about the ATS growth, you will witness in the two segments more primarily. One in the MSME segment, which was around 1.85 million a year back, which we improved to 2.01 million. So we are seeing a good traction in MSME, and we believe the way the growth is coming, and given the COVID is behind us and presently the momentum is building up. So we are finding a good opportunity in the MSME space. So we are looking forward for a 50 lakhs to 100 lakhs or 50 lakhs to 200 lakhs tickets also significantly in this piece. So which is bringing a slightly up over ATS, which was 1.85 million to 2.01 million in MSME. Secondly, the growth you will find in the ATS in the corporate in the NBFC segment, which was typically 15.8 crores, which we improved to 20.5 crores. The number was 18.7 crore a quarter back. So typically with the growth capital comes in, earlier we were giving a very, very small tranche to the very, very efficient NBFCs, given we have a lower capital base. Now we have started moving, which we were doing up to 15 crores of the tickets. We have started doing to the 25 crores to 30 crores of the ticket. So to the larger A minus, A plus type of NBFCs. So which we are doing at a very, very lower ticket, given we have a lower capital. We being on that side, we want to retain our exposure to that extent. So that is the factor. So which helping us to improve this particular ATS, which was 18.7 to 20.5 by over this particular quarter.
This corporate book, not 725 crores in our corporate book, this is how big, what is NBFCs as a percent of that?
This is only NBFCs. There are around 40 to 42 NBFCs in this, and this is completely NBFC based book.
Thanks a lot.
Yeah. Thank you, Sukriti.
Thank you. Our next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hi, sir. Good morning, and thank you for giving me the opportunity. So my question was on other income. So if you look at that, during the quarter has come in healthy. So what explains the same? So if you could just throw some light on that.
So our other income, which was our other income consisting of 24.17 crores in commission exchange and brokerages and 1.51 crores given our FF, which includes our AD2 business and the treasury earning, which was 17.35 crores a year back of the commission exchange and brokerages, and almost so in the other income, core income has grown from 17.35 crores a year back to 24.17 crores in the present quarter. Out of this, as I shared, there is a growth which is coming in all the lines, and the line both from the distribution-based income, which is as we are enhancing our distribution franchise. So there is an increase in our incomes from our banca distribution made by Live Journal or the such distribution. There is a good increase, which was 7.12 crores in the last year September quarter, which has increased to 11.55 crores. So there is around 3 to 4 crores growth coming from the banker distribution, and there is a distribution, other income growth is also coming here. And one more factor I like to mention here, last year, our penal charges were sitting in the interest earning. Now they are sitting in the commission exchange and brokerage, which is constituting around 1.5 to 2 crores. So which is also come at here. So that's necessitated increase over non-interest income, which is presently 1.08 or 1.1%, which was 0.8% a year back. But it's a stable state income, and there is no income which is a very minute, which is typically one time of a nature. So even if you look into this income over treasury earning is not even 1 crore. So it is a purely stable state income.
Got it. So what are the other apps? So we've been focusing on this for quite some time on, on inching up our other income through other avenues as well. So what are the other aspects that we are working or we plan to sort of roll out to boost up our other income?
So as I shared, the current quarter, if you look over distribution income has increased. We have a distribution income has increased significantly, and which we are doing by increasing our partners for our banker distribution to ensure more and more products made available. So we are mindful and more deepening is doing with the clients so that we can continue to increase the share of the earning for us as we move forward. As I shared, the current year growth is there because of a higher distribution and the income from our banker partners, may it be Life Journal or we call it the MI or the third 3-in-1 accounts. That particular share has increased in a good way.
Got it. And just one more thing, to the previous participant's question. What percentage of our NBFC exposure would be towards MFIs and so forth? If you could just give some color there.
So we have a total 725 crores of the exposure to the NBFCs. Out of this, the exposure to the MFI is 59 crores. So NBFC is constituting of the total portfolio around 8% of the NBFC share. And if we talk about the total book, the MFI exposure to the total book will be less than 1%.
Got it, sir. Got it. Thank you so much, sir, for answering my queries. Thank you.
Thank you.
Thank you, Shubhal.
Our next question is from the line of Lakshmi Narayanan KG from Tunga Investments. Please go ahead.
Thank you. A couple of questions. If I just look at your agri portfolio, comparing with the March 2023 ending number or September 23 ending number, the growth has been, if I just look at year-on-year growth, it's around 3% in terms of the gross advances. While growth in the corporate loan book has actually been almost 50%. Now, is the agriculture loan book growth, is it a conscious choice to actually grow at a low number? Because while we are looking, if I just know the corporate loan book, your growth is around 11%. So while your largest segment is actually growing at below 5%. Is it a conscious decision? I just want to understand that.
Lakshmi, if we look into the particular growth number segment-wise, over mortgage book, typically an MSME book, typically grown around 7% on year-on-year basis, agri grown by 3 to 4%, and other loans, the NBFC growth looks apparently high because we were having a very, very lower number, given we raised the capital which is increased over per ticket capabilities. Agriculture growth, which is around 3%, is because of the two factors. I can say it's a conscious choice for this year because when now we are expanding out of the Punjab. Out of the Punjab, we are not concentrating on agriculture. Agriculture being concentrated in Punjab. Out of the Punjab, that's why growth in the mortgage and MSME is increasing. But just saying all this, we believe agriculture still has a lot of potential to grow, and now we believe the growth in agriculture will be better since we were keeping an eye on the agriculture segment for a while, given a lot of ground level activities. Now we are getting some confidence, and we are still looking into the same. And depending upon the macro inputs and the inputs we receive, we will continue to start expanding more in the agri book. So just this year growth look on a quarter-on-quarter basis, though there is a growth from double to 2-3 crores to 2,340 crores, but on a year-on-year basis, this number has grown from double to 6-7 crores to 2,340 crores, which is around 3.5%. So that's a deliberate option we have taken. But if we look into all our three sets, we have 3 product-based companies: MSME, mortgage, and agri. Our MSME and mortgage is growing 17% plus. Both. And we are very confident our retail piece we will be continue to grow as we move forward.
So for the entire year, if I just look at your largest segment, which is agri, what kind of growth you actually expect, given the fact that, I mean, if I just look at your overall 22%, 20% guidance, while how much you think would, what band you like this agriculture loan book to grow?
Instead of giving a product live percentage at this point of time, I believe we are confident to retain over 22% growth target, since we have three product companies, MSME, mortgage and agri. So these three products jointly, which is always constituting around 75 to 78%, they will continue to maintain typically 80 to 82%. We will continue to maintain this number, 80 to 82% of these three products together.
Got it. And second, if I look at your NNPA on an annual basis for agriculture sector, it is actually
I missed Lakshmi, what you asked. The voice was a bit feeble.
Yeah, so if I look at your agriculture book, okay, and if I look at your NNPA, it's up almost 30% on absolute terms. While your agri book has actually grown by 3%. So, do you see some kind of increased NNPAs in the agri book?
There is no, I'm saying, even if we look into presently, or if we look into the overall basis, if we have a GNP of 2.61% bank as a whole, our agriculture book is typically agriculture book is having a GNP of 3.38%. So which was 3.26% a quarter back. So we're typically in the similar range. So typically in agriculture, I'm not that worried about the NNP or GNP in this particular book. And we are confident, since the growth number has not been that high, so optically it may look absolute basis a bit higher. But typically on the ground, the recovery on this particular book is quite decent, and there is no challenge I'm presently witnessing of a significant nature.
Because if you look at the next half year or the near term, we hear from the regulator as well as from some of the other banks that have reported our NBFC, there is risk in the system. Now, while we have been doing exceptionally well several years, and how do you see at this point in time for the near term, what are the pockets of risk you see and how are you planning to address? Do you see an increased risk scenario in the segments you operate in?
Alan, if we look into just a few of the risks which we are seeing is in the unsecured piece, we are seeing a risk in the ticket size of up to 3 lakhs on the agriculture side. We are seeing some risk on the consumption lending side. So there is a risk is building up on these three pieces. So we are quite mindful, and in view of that, our product mix is accordingly realigning. If we go to how we are addressing these issues, so in agriculture we are not in that piece. Our start ticket is 5 lakhs. We are not starting below 5 lakhs. Our start price is 5 to keep us ring fence from that particular piece. We are completely exited. We are not at all in the unsecured lending piece. So the risk which we are seeing is emerging is more in the three pieces. That is up to 3 lakhs in the MFI, or we can say the rural lending, or we can say into the lending which is unsecured, and similarly personal loan and the consumption lending. We as a banker in the consumption lending, we are very mindful of it. So our consumption lending is a second hook to the customer, not a start point. So our consumption lending, which is 7%, is typically to the existing customers, not to the first hook. So we are accordingly ring fencing ourselves from this type of risk. And given our secured franchise with the collateralized, all the books are collateralized except the corporate book, which is 11%. So we 82% plus book being collateralized. So with that thing in sight, so we are confident of retaining our credit cost as we did in the history.
So this credit cost of 0.2% which you have reported, is this something which we can assume for the full year? Is that the band you like to be at?
Yes, I intend to keep our credit cost in a delta of 0.15% to 0.25% for the fiscal.
Got it. So, and if I look at your corporate lending book, if you can just give some granularity in terms of what is the ratings and what is the mix of ratings in your presentation, if it is there, or if you can just tell us in your corporate book how much is in AAA, how much is there, that would be helpful to know.
Typically, if we look into our culture about the corporate book lending, in NBFC, we typically don't lend below triple B minus. We don't lend. And even if a client is up to triple B plus, or I can say the A minus, below A minus, we look for the FLDG for sure. So the growth coming in the corporate book is typically from the A minus to A plus category. So that is where the growth is coming, and we are quite mindful of it. And this particular book is typically not a large, very, very large count. We will be having around 40 to 45 clients, which we are doing at this point of time.
Got it. So it would be helpful, maybe in your presentation going forward, you can add some details on what is the rating profile of your corporate loan.
Can be done. We will take note of it, Lakshmi.
Yeah, thank you. Thank you so much, sir. I'll come back in queue.
Yeah, thank you, Alan.
Thank you. Our next question is from the line of Ashley Sonje from Kotak Securities. Please go ahead.
Hi, team. Good morning, and congratulations on the results. Just two questions from my side. Firstly, when you read the credit bureau reports of your borrowers, whether it is in the agri loans portfolio or in the mortgages portfolio, which are the other typical types of loans taken by the borrower from other lenders?
I request Raghav to take up this question, please.
Yeah, hi. Particularly when we come to this bureau report scrub or on an individual basis also. So this is when we talk of our borrowers. So there are mostly the credit cards or maybe some unsecured loans which are coming onto the records of the borrowers from other lenders. So if we talk of the product mix which we are dealing in, so I can say that we are the primary lender in all these product segments where we are our borrowers.
Okay, and do you also see instances of microfinance loans?
No, we don't, because our customer segment, the target customer segment, so that is particularly the MIG segment, middle income group, and the MFI segment, that is the low income group, that is not our target play area.
Understood. And one follow-up on this one. And when these customers are still repaying to you but might be delinquent on other unsecured loans, what is the thought process when you talk to them about it? As in, how do they think about repaying these loans versus your loan? If at all, if there is anything anecdotal you can share.
I just take up this question. As far as this particular point is concerned, Ashish, so typically, if we look into this, this is a very, very rare phenomena to come. And when we talk about the customer, we typically look for the primary banking relationship. Maybe before if we're making a BT or we are the first to that particular customer, in the middle income customer, he may have few of the credit card dues, which is a very, very not significant values, or he may have a PL with one of the NBFCs or one of the other entities, financial institution. There may be some sort of delinquencies, but this type of delinquencies is very, very rarer of the phenomena. Will not be in a majority, in 90% plus or 95% plus of the phenomena, this will not be the phenomena. So since when we go there, we intend to take care of his complete credit needs. So, but if this type of phenomena come on case-to-case basis, depending upon the circumstances of the case and depending upon our case-to-case circumstances, this action is being taken. Since it is not a gross or the macro level phenomena, I will not be able to give you some guidance as a statistic point of view. But this is a very, very rare phenomena which we are observing in our portfolio over the last 3 to 4 years.
That is fair, sir. Thank you. And secondly, if I look at the other loan segment for you, that seems to have degrown on a YTD basis from about 495 crores in March to 485 now. Any specific reason for this? Is it indicative of any jump in delinquency that you are seeing?
No, that is not the case. This particular portfolio, as I said earlier, is over second or third hook with the customer. So this is depending upon the need of the customer, and it is not our start product. This product is typically more to take care of our primary customer, that is agriculture, mortgage and MSME customer, any additional need of them. So this is typically as per the need of that particular borrower. There is no stress building up on something like this to interact out of it. Or rather, during the quarter, it has grown from 462 crores to 485 crores.
Sure, sir. Thank you.
Yeah. Thank you. Thank you, Ashish.
Thank you. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to Mr. Sarvajit Singh Samra, Managing Director and CEO, for closing comments.
Thank you everyone for joining this earning call. And I thank you, moderator, and everyone who were connected on this call. Have a nice day ahead. Thank you. Thank you very much.
On behalf of Capital Small Finance Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.